500 was a loss of 43.3. No, now it's 55.4. But before, the best year with the S&P 500 was up 54%. Now it's 124.7 for small cap value. Huge differences 1 year at a time. And if we go out to the 10-year, remember, at 10 years, the S&P 500 had a 10-year period. The worst one was a loss of 1.4% a year for 10 years. For the small cap value, it's 7.1%. And in fact, I've got this here somewhere. Yeah, if you lose money at a rate of 7.1% a year over 10 years, that compounds down to a loss of about 52%. That's a big loss. And in fact, if you invested in the small cap value, if you put in $1,000 at the beginning of that period, which would have been, by the way, 1929, from 1929 to 1938, your $1,000 investment would be worth about $480. And so that's not a good return. And you can see that that means it is much more risky than the S&P 500. Now, I'll tell you why I think this is important to point out. In the Sound Investing portfolio page that we talked about several weeks ago, and I'll make sure we have, if you haven't seen that conversation with Daryl and Chris and myself, you would see that the S&P 500 and small cap value had about the same losses from the period of 1970 through 2024. But here you can see significant more risk in the small cap value. Now, this is a tricky business. This could be really important to me if I just held small cap value. Because at age 81, that means that I'm setting myself up for the potential of losing over half of my life savings. That would be like going through a divorce, okay? At age 81, another 50-50 split. That is huge risk, which is why my wife and I have about half our money in bonds, and half our money in stocks, and half our money in large, and half our money in small, and half our money in growth-oriented blend, half our money in value, half our money in U.S., half our money in international. We are massively diversified because we're not so concerned about how much we make, but we want to be sensitive to how much we lose. But for a young investor, it could be a different story. And I want to talk about that for just a second because I did the numbers. I looked at the period from 1929 to 1938, that period that represents the worst for the S&P 500 and the worst for small cap value. And here's what I found out. I already told you that $1,000 shrunk to $48 over that 10-year period in small cap value. On the other hand, if you had taken that $1,000 and dollar cost averaged into small cap value over that 10-year period, even though there were 6 losing years, and the 6 losing years, the average loss was 34%, okay? Even though you had these huge losses, there were also some good years. There were 4 years that the returns were good. It was a very volatile period. Remember, not many people were in small cap values. The markets were not very liquid, so it's very different than today. But that doesn't mean you couldn't still have those losses. But here's the bottom line. If you had invested $100 a year over those 10 years, you would have actually made per year a 9.1% gain. You go from a loss of 52% to a total loss, or a loss of 7.1% a year. You go to a loss, a gain, I'm sorry, of over 9%. And that's the magic of starting out in the bad years. And I might just comment that if you looked at the next 30 years, after you only made 9.1% for the first 10 years, for the next 30 years, small cap value compounded at over 19%. And remember, that's not a miracle because the S&P 500 has compounded for very long periods, as we know, at over 17. And small cap value is more risky. We see it here. And in fact, you'll notice that you have to go out 20 years before you're historically guaranteed a profit. And by the time you get out to 40 years, the range is from 11.6, the worst, instead of 8.9, as it was for the S&P 500, to the best of 19.1. And the average CAGR, compound annualized growth rate, you'll see is around 15%. Now, we know that it hasn't made 15% over the last 55 years. We know that because we track it. I think it was 13.3, if I'm not mistaken. You'll see that in the sound investing. So it did not do as well, but also small cap value is now something that more people know about, and people believe that once more people know about it, that the returns go down. And that might be true of the S&P 500 as well. But you know that if you've been around for a while, that we absolutely believe in diversifying away from just the S&P 500. We don't mean that owning the S&P 500 for the rest of your life is likely to be a bad investment. Don't mean that at all. I think it'll be a very fine investment. But I do know this, that a portfolio that's half in the S&P 500 and half in small cap value, which is what this two-fund strategy is, has a very fine compound rate of return with remarkably similar kinds of risk exposure as you would get in the S&P 500. Now, those of you who have seen the quilt charts, and the quilt charts for this year are not out yet, coming soon. Can't wait for it. I love talking about the quilt charts. But what I do know here through 2022, that the profitability after you get out to 15 years with the two-fund strategy, by the way, notice because half of the money is in small cap value that you still have some losses here at the end of 10 years. And here at 15 years, we finally get profitable. And by the time we get out to 40 years, it's a range of 10.8 to 16. But there is no question, it's still a slightly bumpier ride. And we'll be able to compare that in just a second. But what I want you to notice, and let's just look over here at the at the years where there were losses. You start with 1 year, 27 years are losses. And it goes down to 15 when you add a second year. And it goes down to 13 when you add a third year. And then if you look at all the 5-year periods, there's only 7 losing periods. When you go out to 10, there are 3 losing periods. And by the time you go out to 15 years, there are no losing periods. Now, if we were to include inflation, I would tell you that those 15 years that you made 0.3% would not have been enough to protect you against inflation. But when we compare the two fund strategy, just remember all those 13.9s and 13.5 and 2. When we go to the 4 fund strategy, notice you got a whole bunch of 13.8s and a 13.3 and a 13.1. I mean, it looks very, very similar. The worst 10 years instead of 3.3 is a minus 2.8. So it's starting to look more like the S&P 500 because you have now included some large cap value along with the S&P 500 and some small cap blend and some small cap value. And the return difference over the long term will likely be somewhere between 1/10 of 1% and probably 3/10 of 1%. Compared to the 2 fund strategy. Now, I know I had a written communication from Daryl. I know what Daryl would be saying here today. You would say that he would give the nod to the 2 fund strategy because it's easier to manage. I would say I'm okay with either. The thing about the 4 fund strategy is that you do have additional diversification. And the reason you see slightly lower returns is because you do have that additional. And you'll see that when you see the quilt charts, if you haven't seen them before, where we look at every year and we see very vividly what equity asset classes are the best and the worst 1 year at a time, going back to 1928. But there are a lot of years that the S&P 500 and small cap blend are at the top of the 4 different equity outcomes. You'll hear more about that in the coming weeks when I get my hands on that quilt chart. So let's just look at this final slide, because we can look so easily at the differences. You'll notice the S&P 500 has 1 yellow year. That's returns under a negative 10%. So it is lower risk. You get to lower losses quicker with the S&P 500 than you do the others. You can also see that the returns for the S&P 500 are anywhere from, depending on what period of time you're looking at, from 2 to 3%. And we know that's a big deal over a long period of time. And the risk, particularly after you get out to that 15-year period, the risks are very similar. In fact, once you get to 20 years, you'll notice that at 20 years, the worst period for the S&P 500 was a gain of 3.1. For small cap value, a gain of 4.4. For the 2 fund strategy, a gain of 4.3. For the 4 fund strategy, a gain of 4.4.